Hello, savvy real estate enthusiasts. Today we're tackling a crucial topic that often comes with inheriting property: capital gains tax. Have you ever wondered if you're on the hook for taxes when you inherited property? Stick around as we break down the ins and outs of capital gains tax on inherited properties in this comprehensive video. It's important to understand that capital gains tax and financial forethought can play a large role on the profits from the sale of an inherited property. I worked with a client one time to strategically time the sale of her property so that she paid a lesser percentage on her capital gains. I was able to refer her to a tax consultant that informed her of possible tax exclusions, and in the end we were able to save her money, avoid potential pitfalls, and maximize her after-tax profits. Capital gains tax on an inherited property. It's a complex dance, but fear not, we're breaking it down step by step. First off, let's note the state of Texas does not have an inheritance tax. Let's talk about the concept of a stepped-up basis. When you inherit a property, the IRS provides a fantastic benefit called the stepped-up basis. Simply put, the value of the property at the time of the inheritance becomes the new basis for tax purposes. So if the property appreciated over the years before you inherited it, you're not taxed on the appreciation before the inheritance. Now, the date of the inheritance is actually the date the decedent passed away, not the date that probate proceedings are completed. Let's explore the importance of knowing the value of the property at the time of the inheritance. This value is like your starting point for tax calculations. Knowing this figure is crucial for determining potential capital gains tax. Capital gains tax comes into play when you sell the inherited property. The taxable gain is the difference between the selling price and the stepped-up basis. But here's the catch. If you sell the property relatively soon after inheriting it, the chances of owing capital gains tax are minimal. Why? Because the stepped-up basis often equals or exceeds the sale price, thanks to the property's appreciation over time. However, it's not a one-size-fits-all scenario. There are exceptions and different scenarios that could influence your tax liability. For instance, if the property continues to appreciate after the decedent's death, you might face capital gains tax on a post-inheritance appreciation. Another scenario that's often seen is that the executor of the estate or the heirs will improve the property, so it will sell quicker and for more money. While those improvements can be added to the stepped-up basis, the proceeds above the new stepped-up basis can be taxed for capital gain. For example, let's walk through a calculation of capital gains tax for this scenario. The house was worth $200,000 when it was purchased in 1990. The stepped-up basis of the decedent's death is $400,000. Let's say that you make some improvements: new floors, paint the whole house, install granite countertops, update the master bathroom, and spend $50,000. This increased your value and the speed of sell, and you sell for a profit of $500,000. The starting point for calculating the capital gains is the adjusted basis. In this case, it's the sum of the stepped-up basis and any improvements made to the property. So that is $400,000 plus $50,000. Therefore, your adjusted basis equals $450,000. Now you want to determine the capital gains. So you subtract the adjusted basis from the proceeds of the sale. Therefore, it's $500,000 minus $450,000. Capital gains is $50,000. This is the amount that would be subject to a capital gains tax. Keep in mind that the actual tax liability can be influenced by factors such as length of ownership, any eligible exclusions, and specific tax laws in your area. Also, let's not forget that there can be potential tax implications if the property is used as rental income or a second home. These factors can add some complexity to the tax equation. I highly recommend, for a precise calculation based on your situation, it's advisable to consult a tax professional. Has anyone provided you with your probate home values? As a certified probate real estate specialist, I'm uniquely qualified to provide a probate comparative market analysis, giving you the values of your property at the time of the inheritance and currently. Click the link in the description below to sign up for a free PCMA. As we navigate the complexities of real estate, your questions fuel our journey. If you've got specific scenarios or topics you'd like to delve into, drop them in the comments below. Remember, knowledge is power, and we're here to empower you on your real estate adventure. Stay tuned for our next video. We'll be digging into how to purchase your sibling's share of an inherited property and what to consider. Until next time, this is Erica Parker, your queen of real estate, signing off. Bye for now.